Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Investing in Dividend Stocks. And today, we're talking about where an investor might go to find dividend stocks. We're going to be talking about searching for dividend stocks in today's markets. We're going to be getting some context regarding what's going on with stock investors, including those that are income-oriented. And we're actually going to be planning and placing an example stock trade investment today. So really looking forward to this discussion. A lot to review. We'll set a more precise agenda in just a moment. But before we get to that, though, let me first of all say hello to everybody who's already chatting in. I see lots of familiar names out there in YouTube, lots of new names. So hello there, Richard, Molly, Paul, Kevin, Joe, Scott, Hugh, David, Sean, Rich, blah, blah, sure, Martin, Eva, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you happen to be among those who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, those recordings are a great way to see these webcasts. But if you'd like to be here in the live stream audience, this is a Thursday webcast series, and we kick things off promptly at noon Eastern Standard Time. You're certainly invited to join us here. We'd love to have you here in our live stream audience. Now, as a treat for my live audience members, my very good friend Brent Moores is going to be hanging out in the chats. He's already been there. He's been chatting with those attendees before the live stream kicked off. So Brent's going to be keeping an eye on any chats that come in, any questions. If I can't get to those, he's there to pick up my slack. But Brent's a great resource to have here. Brent and I have been working together now as market educators for more than 20 years. I think we're in our 21st year together on the same team. So yeah, Brent, thanks for being there for me. Now, Brent and I would also like to issue an invitation to everybody watching to follow your favorite Schwab presenters on social media. You can find Brent and me on X. You can find Brent there at Brent Moores CS. You can find and follow me on X at Cameron May CS. And you can also find and follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. But let's get into this discussion. And as we do, of course, dividend investing carries risks. So we need to bear these important disclosures in mind. This material is intended for general informational and educational purposes only. There are risks associated with investing in dividend-paying stocks, including, but not limited to, the risk that stocks may reduce or stop paying dividends. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so we have about 45 minutes to spend together. Here's how we're going to spend it. First of all, we're going to take a look at the markets. We're going to look to see what's going on with stocks, with bonds, and with dividend stocks. That'll only take us a couple of minutes, believe it or not. Then we're going to take a quick peek at our sample dividend stock portfolio, just see how things are coming along. But we want to spend the bulk of our time discussing how an income investor might locate those dividend stocks they're looking for. And I'm going to go through two processes to potentially locate dividend stocks for investment. Then we're going to plan and place a new investment for addition to our portfolio. All right, so let's go right to the Thinkorswim platform is what we're going to be using for this demonstration. Now, not everybody here. I'm watching 613 people watching this live stream right now. I know for sure some of you aren't going to be terribly familiar with the Thinkorswim software platform. So it is trading and investing software that can be downloaded for free from within your Schwab Online account. So to follow along with this, you can download this software. You go to the trade tab in your Schwab account, and just go to, as you click on that, you'll see Thinkorswim Desktop. It's desktop software. So we click on that, and on the next page, there's a great big blue button right in the middle. Just scroll down a bit, learn how to enable Thinkorswim. You just click on that. It'll walk you through the download process. And once you've downloaded the software, it'll create an icon on your computer's desktop that looks like this. It looks like a blue splash. Or you can also find the software in your computer start menu. But you just launch the software, log in using your Schwab credentials, no special username or password required, and that takes you here. So here we find ourselves on Thinkorswim. And I wanted to start things off on the Charts tab on Thinkorswim And we're looking at a symbol here. I don't know that everybody's familiar with this, TNX colon CGI. What this is it's a chart of the rates offered on 10-year bonds. So you'll see a value of 41.36. That means that right now an average 10-year bond yield is about 4.136%. That's what it is. Yeah, Rob V says, it's awesome. No clue how to use Thinkorswim yet. I'll try to go to a pace that everybody can follow. That's always my objective. I don't ever want to leave somebody in the dust. All right. But here we are on charts. We're charting TNX CGI, the yield of bonds. Why do I care about bonds if we're talking about dividend stocks? Well, we might think about these as sort of the competition. If bond yields are going up, they may become more attractive for other income investors. It might cause them to route their cash toward bonds and away from things like dividend stocks. It might cause dividend stocks to come down. Now, that's not necessarily bad, especially if we're looking to invest in dividend stocks. A little dip in price may allow the investor to buy at lower levels and consequently get higher yields on those stocks. So what's been happening with yields recently? They have been coming down in the face of these escalating tensions that we have in the Middle East. Things look like they've settled down a little bit, starting to rally. So right now, up to about 4.1% on 10-year yields. That's a little bit of context regarding what's happening in the bond market. Let's have a look at what's going on in the stock market. Quick peek at the S&P 500. It has been flat. If we look all the way back to the end of October, the 1st of November, stocks have just been going sideways. Well, we're not talking about stock trading in this webcast series. Instead, we're talking about dividend stock investing for the longer term. And interestingly, during this period, when the average stock, as may be represented by the S&P 500, has been going sideways, it's actually been a great period for dividend investors. Let me bring up a different stock index that's more specifically targeted to the dividend investor audience. And what it does is actually charts the net performance of what are known as the dividend monarchs. What is a dividend monarch? It's a company that has been paying dividends for at least 50 years, and it's also a component of the S&P 1500. Okay, so let's go over to the dividend monarchs, and this symbol's a bit of a mouthful. I've recently loaded up, so I have kind of a cheat here. I can click on the little down arrow and go to my recent symbols, and right there at the top is $SPHYDMUT. I pronounce it phonetically SFIDMUT. Sorry, you'll have to forgive me for that one. But let's just choose that. That is the chart symbol if you want to follow along at home. But this index is showing us how dividend stocks have been performing as a group, but specifically that group of dividend stocks that have been paying dividends for a long period. And so this reflects appreciation in the price of those stocks plus any dividends that have been paid. That aggregates those together. And you can see if we go back to November, that same period where stocks in general have been going sideways, dividend stocks have been having a great little bull market run. So could be that there's a little bit of a rotation. Now, we don't know if this is going to continue. Things can certainly change on a dime, but could there be a rotation away from some more of the speculative corners of the marketplace toward maybe some of the more defensive corners, more income-oriented corners of the markets? Possibly. But all of this has added up to, Troy says, is there a difference between the dividend monarchs and aristocrats? That's a good question, Troy. Yes, there is. And I'm actually going to be looking at dividend aristocrats in just a moment. But two basic distinctions. Dividend monarchs paying dividends for at least 50 years and part of the S&P 1500. Dividend aristocrats, not just paying dividends, but increasing dividends every year for the last 25 years, and they're required to be part of the S&P 500. That's a bit of a teaser because that's where we're going to go look for one of our potential investment candidates today. But in any case, let's see what this has added up to for our example portfolio. We just started this webcast series on January 1st, or I should just say the first part of 2026. So we've been building a portfolio, so far adding up to 7 positions across a range of sectors, seeking for diversification in sort of that traditional asset allocation model. But we can see if we look over at our profit or loss column, even as we've just been layering on these positions over a series of a relatively few weeks, up over 5% at a time when most stock investors have seen their portfolios go nowhere. So quick few points to note here. We have invested across a range of sectors. We have a total of 6 sectors represented in this portfolio. We already have a concentration of 2 stocks in a single sector, so we're not going to be buying a utilities stock today. Instead, how about we stay in that defensive mode? Let's stick with the defensive sectors. That might include utilities, yes, but we already have some. Healthcare, energy, and staples are some of the other traditional or sectors that are traditionally considered defensive. It's where when investors are feeling a little bit skittish about investments or about stocks in general, and they're going to sort of capital preservation mode, or maybe put a stronger emphasis on income. These are the sectors where traditional models would say there might be a cycling of money heading. For today, I think we're going to focus on this staples sector. Let's build that one up a little bit. We already have a position in Target, but our positions right now averaging about a 3.7% yield. Their dividends are about 3.5 times as much as an average stock out there. Beta is our measure of volatility. A score of 1 or lower is a lower than average volatile stock. A score above 1 is an above average volatility stock. And so Target's our only stock with above average volatility. We also keep an eye on threats to our dividend payments, including a high dividend payout ratio and high or increasing long-term debt. Dividend payout ratio, if you're not familiar with that, is just what percentage of income is being spent on dividends. If a company's struggling to generate income and trying to pay big dividends, that can be a risk to its ability to continue paying dividends. So a dividend ratio that extends for a long period above 100, that's 100% going toward dividends, can threaten ongoing payment. Long-term debt can be a threat. I'll look at that in a little more detail as we get into searching for an additional position. But yeah, overall, portfolio is doing fine. We will only make adjustments to this portfolio. This webcast series is dedicated to investing, not to trading. So an investor typically has a long-term horizon. We very likely will be doing some rebalancing, which means for this portfolio, we've been building it with each stock representing an initial 5% investment. If the stock does well, that's great. But if it starts to represent more than 8% of our portfolio, we're going to scale that one down, sell off some shares. On the other hand, if it slipped from 5% and maybe fall into 4% or 3%, we'll add to those positions, bring them back into balance. Okay. So that's our current portfolio construction. We've had a look at what's going on with the markets for stock investors, for bond investors, for dividend investors. So now let's build out our portfolio here. Let's add a new example stock. So as I mentioned, let's keep our eye on the diversification here. And we're going to be adding from that staples sector. But how might a dividend investor go about finding stocks? So this is going to go back to the question that was already asked. Somebody asked what is the difference between a dividend monarch and a dividend aristocrat? Now we got 820 people watching this discussion. I know dividend aristocrat is going to be a new concept to some. So as I go back here to our charts, I want to go over here to the left column, and I cheated. If you look right up here, I have a watch list. Actually, I have a duplicate here. 2 watch lists. We don't need 2. We'll just focus on 1. But I have a list of stocks. There are about 60 of them. And these are the current stocks that would qualify to be called what's known as a dividend aristocrat. These are S&P 500 component companies, so they tend to be among the largest companies in the world. But among those S&P companies, there are about 60 that have not only paid a dividend for the last 20 years or 25 years, but also increased that dividend every single year, come strong markets or weak markets, increase that dividend every year, every single year for the last 25 years. That's what one does to qualify to become a dividend aristocrat. Now, that sounds cool. It doesn't necessarily mean that all of them are great investments or that they've all been just screaming upward and delivering consistent results for our investors. But for dividend investors seeking income who have a priority for consistent payment, this might be a place to start looking. So here's what we're going to be looking for today as we turn our attention to the dividend aristocrats. Here are some example dividend priorities. Okay, what exactly might a dividend investor be looking for in an investment? Let's make this bold. Makes it a little bit easier to see. And I'm consistent with this each week. If you were to join me each week or go back and watch the archives from previous weeks, these are the priorities each week. All right. Obviously, it's an income series, so we're looking for yield. That is, on a percentage basis, how large is the income compared to the price of the stock, the annual payment. Number two, we do emphasize diversification for the purposes of this example portfolio. Try not to create a large amount of risk, large amount of exposure, or risk exposure to a single sector. Number three, we are looking for consistency of dividend payments. Sometimes a company pays what's known as a special dividend. They don't usually pay a dividend, or they don't usually pay a very large dividend. And every once in a while, the board of directors will decide, hey, let's pay a big one to our shareholders. Well, that's nice, but if we didn't already own the shares, we don't get that dividend. And if it goes back down or disappears entirely again, it might be just a distraction to the income investors. So we're looking for consistency. Number four, keeping an eye on debt. With a company that pays a dividend yield or dividends to its shareholders, if its funds get distracted by some other commitment that can threaten that dividend. So for example, if a company's been taking on a ton of debt, it works just like your household. Eventually you start running out of money to pay for that debt. So if there's increasing debt and the company has to make a decision, hey, do we pay our creditors what they're due? We have a legal contract with them, or do we pay our shareholders what we promised? But it's easier to break a promise than a contract. Yeah. Usually in that tug of war, the shareholders lose and a dividend can be cut. So rising dividends or rising debt can be a threat to dividends. Number five priority is the volatility of the stock itself. Let me spell volatility correctly. How does that work? There we go. But a typical income investor here's the ideal scenario, I think, for a lot of income investors. We want to buy a stock that just pays a nice, consistent, strong dividend, and it doesn't just chop all over the place. We're up in January and down in February and up in March and down in April, and it's a roller coaster heart attack ride while we're just waiting to collect those dividend payments. Instead, their ideal might just be for a stock to be gently ascending, always going up, a series of white candles on up into eternity. Unfortunately, that doesn't really exist, but can the investor take steps potentially to minimize that exposure to volatility? That's going to be point of emphasis here. Number six is the net performance. So the performance, when I'm referring to performance for our priority, that is yield, yes, but also what is price doing? Because if we're collecting a 4% dividend in a given year, but the stock falls 10%, we lost 6%. That's counterproductive. Maybe we want to try to avoid that as much as possible. So we're going to look for stocks that over long stretches have delivered positive performance between price plus dividends. Now, finally, for some, they may emphasize what's known, well, I'll just phrase it this way, the payment schedule. That might be important to them. I'm going to throw a little asterisk here because it's not a really strong point of emphasis in this series, but it can be for some. If given the choice of two stocks, let's say we already own a stock that's paying a dividend in today's, right now we're talking in March. We have a company that's already paying a March dividend. Sure would be nice if we also had a company paying in April. So maybe stagger the dividend payments among the stocks that we're investing in. That's known as laddering. So for some investors, they may keep an eye on when the dividends are paid. And if we're comparing similar companies and one fits a schedule where we have a gap in our income and the other one is just paying us at a time where we're already getting a dividend, maybe they prefer to buy that one that has a complementary dividend payment schedule. So this adds up to, this is kind of what the income investor may be looking for if this is their list of priorities. So how do they find it? And one way that they might find it is to go to those aristocrats. So as I mentioned, I kind of cheated here. If this is your first time watching, we have this left column over here that allows us to assemble what are known as gadgets. It's gadgets like we can watch the news. We can have a scratch pad like this notepad that I'm using right down here. We can load up a calculator. But one of the gadgets is a watch list. So I can click on the little menu here and I can add a watch list. And what I've done is I've made a watch list of stocks consisting of the dividend aristocrats. So you might say, ooh, Cameron, what magic thing did you use to find the 60 or 62 companies that are current dividend aristocrats? I have access to a tool called Google. And I Googled it. I said, I typed in 2026, I think I probably did this 2025 dividend aristocrats. And I got a list. And then I came here and I made a watch list. So this is how we might do that. All right. So we, first of all, how about we just do it right from scratch? In the left column of Thinkorswim, I already have 2 of these, so we're going to wind up with a third. I come down here and I'm going to add a new gadget. I'm going to choose for this gadget a watch list. And specifically, I'm going to create, so once I've selected the watch list, or I've selected the watch list gadget, now I'm going to give it a name. So right up here, let's create a watch list. And we're going to call this one Aristocrat. How about we just call it Aristocrats to kind of distinguish it from the dividend aristocrats? Same deal. Dividend aristocrats. And then to start building in the symbols, I just type them in. So if the first one was SYY, I just type in SYY. There's Cisco Corporation. I used Cisco Corporation for a very specific reason. Anyway, we just type in our symbols. You just type in a symbol, you hit enter, you type in a symbol and you hit enter, and then click save. And that creates the watch list, right? So, oh my goodness, did I actually make an A in there? Everybody knows that's not an A, right? Aristocrats. Let's quickly delete this one, because now that we know how to create it, I need to erase my shame there. There we go. Let's erase that. Paul says Toss has Thinkorswim has a public list for aristocrats. They do have a public list for stocks paying dividends for 25 years, not explicitly aristocrats. Yeah. But that's how we can build a watch list. And what we wind up with are these stocks. And then we have some columns off to the right here. And those columns can tell us some important information about these stocks. Well, what information is important to us? Well, this might be important information. Yield, which sector we're in, debt, the volatility of the stock, and so on. Let's see how many of these we can address by customizing our columns here, all right? So how do we customize columns? Once we've built a watch list, we can just click on the little gear icon here, select Customize, and I'm going to start adding. These are new elements, new criteria that we can display just right next to these stocks. So some that I will add, well, we wanted yield. Let's choose yield. Add that. We were also interested in diversification, which is the sector. Let's type in sector and add that as a column. We are also interested in let's say the debt load. Let's type in debt, long-term debt to capital. If you're not familiar with that, it's just if we look at the company's long-term debt and compare it to its capital sources, capital meaning funds, that might be long-term debt. It also might be common stock and preferred stock. So we take the debt divided by capital, and it gives us the long-term debt to capital. And if that's a very high ratio, that might be a company that's kind of over leveraging itself. All right, but let's choose long-term debt. What else did we have? We had volatility. A measure of volatility, as we've discussed, is beta. Let's choose beta and add that. Beta just benchmarks the company against the S&P 500 and compares it to how volatile it compares the company to the S&P 500 historically for volatility. So if we have a company that tends to move up when the S&P moves up, we'd say it has kind of a one-to-one relationship. It has a beta score of 1. If the company moves up when the S&P moves up, but it moves up faster, or falls when the S&P is falling, but falls faster, it would have a greater volatility and have a score above 1. For some dividend investors, they might prefer a beta of less than 1, a less volatile stock. But that's it. We might just create a few custom columns here. And now we can see the market capitalization of the company. We can see the last trading price. But here are all the new columns that we've added. They're a little bit squished. Well, we can just widen this column out. We just click on the little margin in between, and there we can start to see these. Or, oh, David says, is there Thinkorswim training on YouTube? Absolutely, David. As a matter of fact, I have a dedicated weekly webcast series. It's called Getting Started with Thinkorswim. I even created a series of lessons where you can just start at lesson 1 and move through the series where it talks a new user all the way through the platform, basically. And that's found on our YouTube channel. So do yourself a favor. If you're new to this, if you're new to Schwab Coaching or new to this webcast series, first of all, pop down below the video right now and just click on subscribe, because it only takes a second to subscribe to our channel. It doesn't cost anything to do that, but this is where you can join our live streams. We have something new every market day. We have 6 or 7 live streams every day. And you can also find the playlists of previous webcasts. So I'm going to go to playlists, and let's scroll down a bit. So this one again is called the one that we're looking for, Getting Started with Thinkorswim. And it's my webcast series. We have a ton of webcast series that are recorded here. Mine happens to be banished all the way to the very bottom. Just scroll right on down until you can't scroll anymore. And there it is, Getting Started with Thinkorswim. View the full playlist right there. And we can see previous webcasts where we explore all sorts of different features on Thinkorswim. If you want the structured lessons, though, just scroll down through these archives until the word lesson starts to jump off the screen at you. It'll only take about a second or two of scrolling. There's lesson 1, downloading and navigating Thinkorswim. Lesson 2 of 8 is mastering the monitor tab. And I just go through in a structured fashion, okay? All right, but let's go back here. And we've just created this watch list where we're tracking the dividend aristocrats, emphasizing our priorities right here. And we're going to make a selection. Now, one other feature is we can minimize and maximize the width of that column. Another thing we can just do is detach this watch list from the Thinkorswim platform. If we choose Detach Gadget right here, it pops that out as its own separate window, which I have already done. Here it is. Honey Lemon, you subscribed. Thank you. Excellent. All right. Well, let's look at some of these companies. And so here we are looking at the dividend aristocrats. Here are those 60 or 62 companies. Here's the size of the company, the last trading price, the yield. And what I've done is I've gone to the sector column and I just click on that. That actually organizes these by sector. And let's scroll down through these sectors and look at staples. And just in the interest of time, I had a look through these before the webcast started, and I wanted to draw our attention to SYY. We already own some Target, okay? So we're building out that staples portion of our portfolio. Let's learn a little bit about SYY. So this is Sysco, SYSCO. It's a $41.5 billion company. That's 41,000 millions is 41 billion. Trading right now at about $87 per share, paying a 2.9% yield, 2.5% yield, my apologies. That's about double the average yield. Right now, an average dividend paying company in the S&P 500, about 1.15%. It is in that staples sector. Its next dividend date, ex-dividend, is in April. Okay, well, we're getting a bunch paid in February. Its long-term debt to capital is around 79. That's not the highest here. It's certainly also not the lowest. That just means that its long-term debt is about 79% of its total capital. That is debt and stock. Okay. And then finally, it has a beta of 0.59, so it's a lower volatility. It has a score below 1. It's a lower volatility stock. So let's keep an eye on SYY, but we're going to go do a different search and find another stock. So building a watch list of companies such as the Dividend Aristocrats may be one way for dividend investors to find stocks. Barbara says, can you explain why you chose Sysco? Well, Barbara, size of the company, yield was certainly a consideration. Ex-dividend date, the scheduling of the payment was a consideration. Basically, all of these. Now, what I would like you to do is see if you agree with the choice. If you see something else here that looks a little bit better, at least in your view, make a note of that. Now, there's a final thing that we haven't seen. I'm holding it until the end, and that is the long-term net performance of dividends plus price for our stocks, right? There are lots of these companies that may look competitive on the surface here, but boy, they have not performed over the long term. So those were eliminated from consideration, all right? That was actually the majority of for the majority of these, that was the reason. So for example, if we look at something like, let's pick on Clorox for just a moment. This is skipping a little bit ahead. I don't mind at all. Let's type this in. On a one-year chart, an investor, developments over 1 year may or may not be important. Let's go to a 10-year chart. What's been going on with Clorox over the last 10 years? Well, price has gone up, it's gone down, but boy, overall, it's pretty much sideways, even bled out just a little bit. Now, over that period, it has paid dividends, and because it's in the Dividend Aristocrats, we know that those dividends have been growing. But this chart actually doesn't reflect those dividends. There is an adjustment that can be made to a chart to show the net performance of price plus all the dividends that have been paid for that period. That can be done right up here, where it says the chart settings, the little gear. I'm going to change that. Stocks are also known as equities. I'm going to go to the equities tab of the chart settings. And right here it says adjust for dividends. Right now it's only showing any giant special dividends that have been paid. I'm going to show them all. Let's put in all and click apply and click OK. And what you'll notice now is there's a slight upward slope from left to right, whereas previously, if we were only looking at price, there was a slight downward bias. That previous chart is what's known as the traditional stock chart. A traditional stock chart does not include dividend payments. It only shows us how price has done. So this is building in a total return chart, price plus dividends. So overall, it's up maybe net 35, 40% over 10 years. So from the perspective of this webcast series, that just wasn't strong enough. So I eliminated that. So that was one of the primary reasons why I went down through that list and settled in on SYY. Do we want to take a look at SYY? Let's do it. Here's SYY. That's what it's done. Total performance over the last 10 years. Have there been some rough years? Hello, COVID. Yes, absolutely. There have been some rough years, but overall, price plus all of these dividends growing consistently over the years has added up to a net strong performance. Barbara, it was a great question. All right. So looking at the dividend aristocrats is one way that we might find investment candidates. Not the only way. There might be some perfectly good companies out there that maybe they only started paying dividends 20 years ago, so they're not qualified. Maybe they didn't raise their dividend every single year for the last 25 years, so they're not qualified as an aristocrat. Let's go look among those. Users just had a question here. How do you find DRIP stocks? Well, DRIP is typically an acronym for Dividend Reinvestment Program. And to reinvest dividends that are collected back into stock shares, that's actually just a selection that's made on Schwab. So you go to your Schwab account, go to your portfolio, there'll be a column that says reinvest. It's just one word with a question mark, and you can just choose yes or no. All right, but let's go look for some non-dividend aristocrats. They may still be good, perfectly high quality companies. So we're going to do a scan. Now, once again, if you've been part of this series before, you know that I've already built a scan previously, and it's known as we call it the dividend working class. Not truly dividend aristocrats, but here are the elements. Let me show you how it's built. First of all, we're only going to scan in the public watch list known as the S&P 500. So we're directing this scan to a specific corner of the marketplace. Next up, we're going to be emphasizing those priorities for our portfolio, starting with yield. Okay. So right here for one of our stock criteria, let's just choose yield. And how about we look for at least 2%, up to maybe 6%. Really high dividend payments, they can be hard to maintain, hard to sustain. So let's maybe put a theoretical cap there. So of our S&P 500 companies, maybe they're about 191 paying a dividend between 2 and 6%. A second criteria, maybe the size of the company. Now, these are all pretty big companies, but how about we put a market capitalization requirement of, let's say, 10,000 million. That'd be a $10 billion minimum. And there are 475 of the 500 companies that meet that requirement. Let's also look at the beta. That's our measure of volatility. And let's just say we're looking for below average volatility. Let's maybe put a minimum down there at 0.5 up to, somewhat above average volatility of 1.5. 1 is average volatility, so 50% less or 50% more volatility is going to be the range there. And let's see. How about, let's also add our debt. So that's a fundamental criteria. Let's pop up here. We've run out of filters, so we need another one. Let's go up to add a filter, and we're going to choose a fundamental filter. And specifically, this is going to be long-term debt to capital. All right. And how about we set that with maybe a maximum of 50% long-term debt to capital. That's it. That's going to be our scan. Let's run scan. And in the interest of time, I've actually had a look through this scan already. And for our sectors, let's have a look. Let's go down to our staples. And I noticed, oh boy, I better pronounce this correctly. I believe it's Bunge. But consumer staples company in that same sector as SYY, let's say how it's been doing over time. So we have BV. And over time, it certainly also had its ups and downs, but net, it's been quite a strong performer. Going back to our scan, though, we can see Bunge dividend yield of about 3.1%, a little stronger than SYY, paying, last paid in February, so we'll be waiting a few months for the next payment, Long-term debt is a little lower than SYY. Market capitalization is a little bit smaller. I think SYY was 41 billion. This is a $21 billion company. So which one? Why don't you chat in and let me know? Let me know if there's any of our elements here that we might want to see again. This is a lower debt, lower volatility company paying a little bit higher yield. Both are in that staples sector, but this is the smaller company. What do you think? Which one? So give me your vote. There's the chart of BG. This is the total returns chart over the last 10 years again. And if it's helpful, let me throw SYY on here one more time. There we go. And as soon as I have 3 votes for one symbol, that's the one that we'll add to our example portfolio. So I have 1 vote for BG. I have a second vote for BG. Here comes Hugh with SYY. BG. All right, BG it is. So let's go invest in BG. By the way, if you ever stumble across a company and you want to dig a little bit more into it, you don't know what it is, you can actually go to, on the Thinkorswim platform, go to the Fundamentals tab. This tells you fundamentally what a company is. Let's type in BG, and this will tell us Bunge. It's a agribusiness and food company. It operates 4 segments: soybean processing and refining, basically, grain merchandising and milling. This is an old company. This was founded in 1818, headquartered in Chesterfield, Missouri. So let's go place our trade. Oh, and one other thing. If we're on our chart, we know this is not a dividend aristocrat. We actually are looking outside of that. But we can look at the icons down at the bottom. These green icons tell us the dividends. There's a 50-cent dividend back in 2018. This is a 50-cent dividend, consistent but not growing. That's why it's not an aristocrat. Now it's starting to grow, 52 cents. What is it here? 62 cents, moving more to the present day, 70 cents. So growing over time, just not every year. That's why it's not a dividend aristocrat. All right, but let's go add this to our portfolio. And the way that we place a trade on Thinkorswim is we go to the Trade tab. We make sure we're looking at the correct symbol. And for this webcast series, we buy about $10,000 worth of a stock. That's about 5% of our theoretical or our example $200,000 portfolio. So let's do some quick math here. $10,000 divided by 120 bucks per share. It's going to get us about 89 shares. Let's go buy those shares. To place our order, we go to the ask price and just click on that price. That'll bring up a default order to buy 100 shares. We're just going to change that to 89. And I'm going to submit this as a market order. Obviously, market orders carry risk. We may not be thrilled with the price that we receive. It's around $112.63. Might be more, might be less, but I'll click confirm and send. Buying 89 shares of BG at the current market price. There's no commission on this trade, but there can be on some types of trades. But that's around a $10,000 investment at that price. So let's send that off. Looks like price has climbed just a little bit. Yep, and we pay $112.87. Guys, we've accomplished what I set out to do today. I know that was a little bit of heavy lifting. The nice thing about these webcasts is that they are recorded and then added to our playlists on YouTube. If you want to go back and revisit any of the little clicks that we've made, any of the logic of the decisions that we've come to, you can go to the YouTube channel. But we have reviewed current conditions. We looked at our existing portfolio, and we went through 2 different ways that a dividend income investor might look for a stock investment. But let me give you a couple of final reminders of the resources you have available to you from Schwab Education before I let you go. First of all, if you are new here, if you haven't subscribed to our channel, make sure you do that right now. You pop down below the live stream or just below the video on the recording, click on subscribe. It only takes a second, doesn't cost anything. But our Trader Talks channel is where you can join these live streams or you can find playlists of previous webcasts. I'd also strongly encourage you to follow your favorite Schwab presenters on social media. So you can find and follow Brent and me on X. You can find Brent on X at Brent Moore CS. You can find me on X at Cameron May CS. So there's my handle. I'm very active here. And if you follow me here, and if you reply to one of my posts, I just try to reply right back to you, and that allows for interaction when the camera's not on. I get questions all the time. Cameron, how do I reach out to you in between the videos? On social media, so on X, or you can also follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS will take you right to my profile here. I've only been on LinkedIn for a few months, but if you reply to my posts here, I try to reply right back to you as well. Everybody, thank you for giving me your time today. I hope that you'll put it in your calendar to join me in future webcasts. I will certainly look for you in those webcasts. Also, if you enjoy one of our webcasts, make sure that you click the thumbs up button. That sounds like applause to your presenter. It also gives a boost to my video in the YouTube algorithm so that more people can find these discussions, like how do we find dividend stocks. Thanks a lot, guys. I will see you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy investing. Bye-bye.